to pick up where I left off. I think that's always the best place to do it. In my weekend review video, which turned out to be quite prescient again. One of these days I'm going to screw it up, right? And I'm sure my haters will love to point it out, although I at least keep my records. I don't delete my tweets, I don't delete my videos. It's all there for the world to see. Anyway, let's get cracking. So I had talked about the SPY. I'm just going to dive right into the markets. And I had said that the head and shoulders pattern that everyone was talking about, to me, was not as clean of a pattern as I think every technician and his mother might think. I actually thought it was a bit of a descending channel, and I thought that the pullback was rather mild. All right, so let's dive right into that. Why was this head and shoulders? Not all head and shoulders patterns are created equally. And I'm going to talk about the one that I called in IBB and why I believed in that one, and then why I didn't believe in the SPY one. So let's start out with SPY since that's the most recent. So the problem for me with the head and shoulders pattern here was, first off, we got into the 210 SPY, 210, 211 resistance, and I had said that that was going to be a point of some contention, that there would be some back and fill, and the question was going to be whether it was sharp and violent, which would have been more bearish, meaning like a V type of reversal, or if it was going to be choppy and, you know, a struggle, you know, lower. So it really wound up being that more latter one, the choppy and struggling to get lower. I told you guys and gals that the internals of the market on days that were being sold off were less strong than on up days to the upside, meaning that their ferocity of buyers was stronger than the ferocity of sellers on the way down. You had days that were down with, like, you know, where bears were trying to push the market lower with positive breath. When you have a real bearish tape, and I mean when things are falling apart, you don't have what I refer to as actualizers, meaning that you don't have individual stories that are still doing well, like Amazon's and Facebook's or whatever at the time. Everything is red across the board. It's down hard with 8-to-1, 5-to-1, 8-to-1 negative breath, and it's just a bloodbath of amphalotic selling, because that's when the OTF, meaning the other time frame, institutional money is in there selling. That has not been what we've been seeing. If anything, we've been having these late day liquidation breaks or late day rallies, which just means that everyone who was short the prior day and that day covers on the rallies, and everyone who bought and chased on the longs dumps it into the close. That is not how the OTF tends to trade. They tend to have the trend type days of, you know, you open week and you just all day long completely sell off with negative internals, or the same to the upside. Yesterday we did have a trend day to the upside, but it was more of the short covering variety. The breadth, though, was pretty palpable, because we've had so many attempts, I guess, by the bears to sell off. You had so many people short. I was involved in a few tweet conversations with some people, and all they were doing was measuring head and shoulders, you know, endpoints, and I just said, you know, I'm the least bearish on the stream here, and, you know, I think that the market was going to go a little bit higher. So that really happened in quite dramatic fashion yesterday. We broke the down channel, and today we actually broke the down trend. We closed above trend. So as many of you have come to know, I have become, I guess, in maybe some circles, notorious for my SPY levels. I really live by them, and I follow them. It's sort of like Top Gun. You never leave your wingman. I never leave my levels. So when everyone is saying, you know, oh, we're bullish, or everyone's saying, oh, we're bearish, I kind of tune that noise out. If anything, it is encouraging to me to do the opposite, and I just go by my levels. And I was talking to somebody, this was on DM. There's a few people, a lot of you talk to me on the stream, but some of you are into more private conversations, and it's on DM. I really wish it was more out in the open, because I think it would benefit more people, but hey, you know, I answer DMs. And the question was going to be, what would turn me from being more bullish to bearish? And the answer was very simple if you watch my videos, that if we had a Friday close or a weekly close below, even some daily closes below 204.12, I would start getting more bearish. We did not have that. On, I guess, 5/19, that's the day, We had what I referred to in the video as a look below and fail, and we closed with a hammer into the prior day's range, and we closed that day at 204.20. We knew that the Fed was talking more hawkish. The bears had the neckline snap, and they couldn't even close the market below the neckline. So when you have everyone pushing short for multiple days, and they're kind of the weaker hand shorts, they get squeezed. The next day you had a gap up. The next day after that was some consolidation, and then you have what you had yesterday, where it was a gap and go to the upside. All of the people who were wrong, and I had talked about being long over that hammer, they had the gap and it held, and I guess they finally threw in the towel here. The good news, there's some good news and some bad news here. Do you have a chat room or a website where I can find you? You can't find me. No, I'm just kidding. Yeah, you could find me on Twitter. My handle is @JustinPulitzer. You could also subscribe to my YouTube channel. That's Justin Pulitzer Trades, and here, right here on Periscope. I will be starting a pay service at some point. I've just been busy with other things. I also have felt that I wanted to kind of build up my following a little bit more before I went in and did that, kind of iron out some of the kinks, just get used to broadcasting and so on and so forth. I am not a a professional TV personality, although I guess I'm getting a little better at this. I seem to be getting more people who are enjoying the broadcasts. All right. Anyway, with regard to SPY, so we had the gap. Today was a little bit of continuation. Usually when you have business that's being conducted, not everyone had a chance to cover yesterday, so they covered today in size. You had a gap. You had a little bit of some stagnation, and it kind of, you have two very poor structured days. Yesterday there was a lot of single prints to the upside, which is indicative of short covering. It would not surprise me if there was some pullback. I want to be a little bit careful now that we've rallied in front of Yellen, who speaks on Friday. So I'll address the Fed in a moment, but first let's talk about the key SPY levels. So there's good news and there is maybe not good news. It's still to be determined, but let's talk about that. The good news is we've broken the down channel, we've broken the downtrend, and we have negated the head and shoulders top pattern. It is void. The reason for that is that you have a higher high on this leg above the theoretical right shoulder, which was 208.54. We had a close over that level today. Even if we come back down tomorrow, the head and shoulders pattern is negated. It's over. If anything, we're starting to maybe look like we have an inverse head and shoulders forming, believe it or not, as crazy as that sounds. But we'll see how that plays out. The key levels here, one where we had the double top reversal was at 209.76. Today's high of day was 209.77. We really need to clear that for more continuation. We could have some chop and stagnation. Short term, 208.97 was an important, that's really the vestibule for the upper distribution, and we did close above there today, which is nice, very nice. I would start getting a little bit more iffy if we start getting closes below 207.97. I don't want to get into, I don't want to get into too much why, but that is another level. It's an important one, and let's just leave it at that for now. Yesterday, though, was, like I said, a gap and go. We cleared the 20, the 50. I mean, we're just like a stone's throw distance from the all-time high. The fact that we negated the head and shoulders pattern still has me thinking all-time highs are in play. Yes, there could be some pullback. It wouldn't surprise me if there's some pullback tomorrow ahead of Yellen. God knows what that woman is going to say. I'll tell you this. You guys asked about the Fed. Let's just talk Fed, because that's the 800-pound gorilla in the room. So the Fed heads you have a very, very weak bench of Fed people other than Janet Yellen. A lot of these people aren't Nobel laureate economists. They're just average schmoes who are on the Fed now, in my view. A lot of them are trying to talk tough and sound hawkish, and they keep citing the data being great, or the data is improving. So I'd like to know what data they're looking at, because the published data, the ones that are available to you and I, have been bad. Other than the housing numbers and some auto numbers, which were a little bit better yesterday. We had a PMI today. Today was the service one. We're the big service economy. It was lower than the prior read. It was not very good. I had pulled that up. I actually didn't tweet about that today. I probably should have, but I'm talking about it now. I wanted to save something for people who, tune in, spend the time. So the prior reading was 52.1. Today was 51.2. I have to do a deep dive inside of those numbers, but it wasn't recessionary. But hey, things are slowing. That's not, great numbers. Let's talk about, the jobs numbers. I heard Bullard today. That guy loves to talk, right? He just loves to talk. The employment number that I saw, the prior reading was 215,000. That was lowered to 208,000, so a revision down. And then the consensus estimate for this one was 200,000, and we were 160,000. Excuse me, where are the good numbers? Where are the good employment numbers? They are crappy jobs, part-timers, people who are, I joked around about the carnival ride operators. That's actually a thing. I know I kid, but it's real, and it's sad, and it's terrible. And, all I'm reading about is more and more AI and automation. I posted some stuff today with McDonald's. The military is getting more and more into that. And it seems to me, as we raise minimum wages and add in Obamacare taxes, that pace of automation is going, and AI is going to accelerate. It's been hurting like the lower wage jobs. I think that, believe it or not, is going to start hurting some of the white collar jobs eventually too, and maybe sooner than people think. And I've heard Yellen once. I was in a car ride out to the Hamptons, and I was listening. This was, I think, last summer, maybe the summer before. I think it was last summer. I was riding shotgun. I wasn't driving. I was actually monitoring and trading the markets or whatever, and it was a Yellen speech. And I heard her mention technology, which I found very encouraging. What makes me a little nervous is that the Fed seems to think that we are still in a normal business cycle. That's sort of like your sine wave, you're up and down. Yes, we are within those, but it is in the bigger picture of a structural change and decline. The jobs that technology has offset are never coming back. Ever, never, ever, never. They're actually only going to get worse. I started the day with an article today from the New York Post talking about sex dolls and AI that's coming into that industry. Remember, and I know this is going to sound crazy, porn is what decided the difference between Blu-ray and HD DVD. This could be the start of everything. It may sound nuts, but it could start there and go into factory workers. And we all know how this ends. We've seen Terminator and The Matrix. It ends very badly. It starts off nice. Companies have more profits, but then come the layoffs, and then come the Terminator stuff. That's no good. So that is what's going on. I cannot stress for you. Think about this. I read an article today, and I was going back and forth into Twitter about how aircraft carriers might become obsolete, that the planes, the F-18s and now the F-35s only have 500 and 550 mile capacity, and that China has invented some kind of missile that can go 800 miles. So obviously the easy fix there would be to have planes with larger distances so the carriers can be further away, or have stealth refueling. What's going to eventually happen, though, is that it's all going to be automated in AI. They're not going to have these carriers. Think about if they took those fleets out of service and you have 7,000 or whatever, I think I read, people on those boats. That's going to be like amazing into the unemployment numbers. The military is kind of shrinking as it is as we rely more and more on automation. Think Cyberdyne Systems. This is real, and it's happening, and it's going to just get faster and faster. I also think that social media and online have eclipsed a lot of traditional industries. People are getting their news on Facebook. There was a big dust-up about them not being so great with conservatives or whatever. These trends are real, and the Fed better pay attention to this. They start hiking interest rates into a declining economy, they could have a disaster on their hands. Anyway, that being said, so that's my take on it. I want to talk to you a little bit about the probabilities. This is why the market got its feathers in a ruffle or whatever. I wanted to use something a little bit more lewd, but since we already talked about the porn, I'm going to keep it a little cleaner here. So June, there's only a 28% expected rate hike. I had talked about this in a couple of videos ago, that the probability of the Fed hike was being overly discounted and there had to be some type of a snapback. The snapback wound up being way more. You know how I often talk about support levels? When you rally early off of a support level, it's like a slingshot not being pulled far back enough. In this instance, the slingshot was not only pulled back far, it was like beyond the normal range, and the snapback was like snapped in your face. So something that went from like a single-digit probability is now 28%. The big problems became these, though. July is now 56%. September, which was well below 50, is now 64%. November is 67%, and December is like a done deal at 79%. I have been saying I've been on board for one rate hike this year, and that I thought that would come in December given the data. This now, to me, is saying that the Fed is thinking, maybe tinkering with the idea of 2 rate hikes or maybe 3 rate hikes. I am not, whether you do the American or the German, I don't know, whoever's where, I've been getting a lot of international viewership, so I'm trying to be a little bit more multicultural here. Although the broadcast will always be in English, at least the initial one. Can you just picture me speaking and then there being like Chinese words? It would be amazing. Anyway, so I think that what Wall Street got nervous about was that the data isn't good, the Fed is saying it's good, and that they could raise rates prematurely. I'm a little worried about this. I will tell you, just because the Fed shouldn't do something doesn't mean they're not going to do something stupid. They shouldn't have really raised last December. They should definitely not raise now. I love how Bullard, let's go back to Bullard. I hate picking on him, but he makes it so easy. He's sort of like this. Anyway, he was talking about, let's see how the data is this month. The Fed doesn't need to just see one set of data or 2 sets of data, in my view. They need to see a trend. They need to know things are stable. To turn, like for example, to turn a little speedboat, or a dinghy is very easy. To turn a battleship or an aircraft carrier like the Fed is not. So for them to hike and then maybe risk, things going badly with, stall speed growth like we had, I don't know what they're talking about. We have GDP that's below 2%. You have inflation below 2%. They can't even reach their inflation and GDP targets. And Yellen, in her last speech, her sort of "I'm sorry, I didn't mean it" speech, wasn't even talking about reaching inflation targets for 2 to 3 years. So I don't know what they're talking about raising here. If there was an economic shock, like an earthquake, like the San Francisco earthquake in the early 1700s, you would have a disaster here. I mean, you could have a recession, a very deep one, actually. The economy is definitely a lot different than it was back then, but I think it would be very bad. I mean, look what happened with the Japanese earthquake in 2011. We had like an 18 or 20% market correction. Imagine if it happened domestically in the U.S. It could be quite ugly, and it's not like you're starting off, on terra firma. So the Fed is playing with fire here. You have almost recessionary growth. You've had a very weak first quarter for the last 3 years. The second quarter, they've already been revising down. The Atlanta Fed, not a pretty situation. You have PMIs that are not great. You have GDP that is not great. You have employment that's really kind of iffy. They should not be hiking. If they do, my fear is that they have moved too soon. They are again on the wrong side of the policy error, and you could see a 200-point decline in the S&P 500 like that. That is the reality of the situation. We'll see what Premier Yellen has to say on Friday. I believe in booking some profits into rallies. We've had a big one. We may need the Fed to break out of the range that we are in here. It is encouraging, though, that we are back to the 210s and 211s from a higher low after, some consolidation up in the upper part of the distribution, and we kind of had a look below the upper distribution level, which I define as 204 to 208.97. A fail, and now we're looking above. So let's see if this can hold or not. The meat of today's rally, if we lost today's low of day, I would say I'm a little cautious. If we start getting back below the 206.86 area, 206.80, that gets a little more still iffy to me. These are the areas that excuse me, that the market really needs to hold if it wants to kind of keep its mojo going. Yeah, I think that covers things with that. Let's get to your list. I think that covered it. The other big risk that I've talked about in the market is the dollar, which is starting to come on. That got way overdone. I was expecting a bounce. It is now back over the down channel line. It isn't over the downtrend line, and it wasn't particularly acting super-duper well today. But it's definitely could have a little bit more room. A 50% fib would take you to 96s. A 61.8, which is really where the breakdown took place from, is back up to 97s. I would, believe it or not, I know this is going to sound nuts. It's sort of like a one-legged man in an ass-kicking contest. Is the higher the dollar rallies, the less likely the Fed is to hike. Although everyone's going to think when the dollar is rallying that it means the Fed is going to hike. So it's sort of like it's a circular reference. If those of you who use Excel, it's one of those circular references. Like I said, the higher the dollar rallies, more people will think they're hiking. But the higher it does rally, the less likely that the Fed will want to hike, because a stronger dollar is not what they really want here. It would make it's a big risk to the economy. That's also, I think, why you had seen a fairly decent rally in the market. Let's talk about PE multiples and weighted average costs of capital and boring things like that for 2 seconds. I promise you, you'll like it. If you don't like it, you got to eat your vegetables, right? It can't just be all ice cream. Anyway, the deal here is that interest rates are low. They've been historically low for a very long time. It has chased people into risk assets. They can't just keep their money in bonds or in CDs because it's below the rate of, there is low rates of inflation, but there is no rates of return. And we all know that the real true expenses, that of energy, which has been a tailwind, is now maybe becoming a bit of a headwind. Insurance, health insurance is up huge. Rents are up big. People's costs of living are kind of up. So in that instance, yes, maybe the Fed should raise, but in the true sense, with economic readings, they shouldn't, if that makes sense. Anyway, the point being is that they force people into risk assets. Even weak and declining earnings, and we do have an S&P that isn't trading cheap. It's trading 19 times earnings, assuming the earnings power stays up, and we know things have been weakening. The piece that people miss there, in 1929, in 1987, I have to double check that, but in 2001 and in 2007 for sure, interest rates peaked at 6%. In 29 they peaked then, and in the two recent meltdowns in 2001, and then in 2007, rates were 6%. We are below 2% here. That commands and deserves a PE multiple premium, because the discount rate, the risk-free rate, which goes into the weighted average cost of capital, and I'm not going to glaze you over with this, just think about it as a numerator and a denominator. The denominator is where the risk-free rate goes. If you are dividing a top number by a lower bottom number, you get a larger end product. If you're dividing a top number by a higher bottom number, that would be the higher interest rates, you get a lower end product. Always think of that. That is the truth about interest rates. I assure you, I have a very fancy degree from a very impressive business school. They taught us when rates go down, prices go up, and when prices go up, rates go down. That is the relationship. I know the TV media likes to talk about bonds rallying and that being bad for stocks. It is the exact opposite. Low interest rates are phenomenal for stocks, and that's why it's up here. If bonds started collapsing and you started having a competition when you have 5 or 6%, think about when you buy a dividend stock. What is the amount you look for? 5 to 6%? Maybe in this environment we're down to 3.5%, 4%, which is oddly where the Fed says they're looking to normalize 3.5%. But historically, it's 5 or 6%. That's a good dividend. If you can get that in bonds, you don't need to risk in stocks. I'm talking about very wealthy people, not guys with $10,000 accounts. I'm talking about people with millions of dollars who really move the markets. They don't need the risk. They take it out, they put it into bonds, and you get that that nasty sell-off into the equities until things kind of balance out and the risk-reward becomes good again. The Fed and what they have done have suppressed interest rates for so long, for so low, they have forced people to buy the Coca-Colas. That's why Coca-Cola is trading 26 times earning to chase a 3.5% dividend, because that's where the only game is in town, and the Fed knows this. If they start hiking rates, it's going to get, it's going to get nasty. That's just how it is. It might not happen the first hike, which it didn't, although we did have a bit of a shock and awe. It might not even the second time. But if they keep going, it's going to get nasty because we don't have growth. Back then, think about it. We had a lot less debt. We had a much brighter future than we do. At least we thought we had a brighter future then. No one really is excited. There's no euphoria in the tape here. People are, why do you think Bernie Sanders and Trump are doing so well? Things are not going well. All right, so I'll step off my soapbox. We'll get back into some of these levels here. Gold and silver. I am long silver from 14s via SLV. It's pulled back quite a bit. I should probably throw a Fibonacci retracement on this. I haven't actually looked at this chart in a while. Let's see. Alrighty, Fibonacci. All right, so we are getting close to, only a 38.2% fib here. I will start getting interested in adding to these things or buying more, particularly, let's say, gold, if we start getting closer to the 50 and particularly the 61.8. Gold loves technicals, and it loves 61.8 Fibonacci retracements. At the very least, that should be a bounce point. Silver could come down. It has a big gap to fill. That's really where this started in the 14s again. I don't know that we're going to get there, but if the dollar does keep rallying, you could have a situation like that. I pulled up Gilead. I really meant to pull up gold. GLD basically got to a kind of neckline of this distribution, and it held today, which is 16. I have it as 16.16, although I'd be willing to say you could give it a little bit more finagle room, down to like maybe 1608-ish. Let's just say 16. Anything below there to me gets a little bit iffy. What am I thinking? Let's just use the last swing low. I guess it's a long day and I have the sun beating on me here. 115 was the last swing low before the kind of last higher high. When you break a pivot level, that usually indicates a top. If you lose 115, I think you can probably play short on bounces. I'd be looking to re-enter that. The 61.8 there is like 109, and you have a bit of a node around the 108s. I think around there I'd probably be looking either BTD or sell some out of the near dated out of the money puts, or maybe both. If you've got if you've got the Huevos Rancheros going, you could sell puts and buy calls, or buy call spreads. Do that risk reversal, or risk reversal call spread, or there's a lot of ways you can do it. But I like that. I'd also be into, if you want to play the downside, playing put spreads or put ratios if we break the 115 pivot. Let's just keep it simple, stupid. So that are those levels. Let's talk about some of the momentum stocks. Apple. Let's start with Apple. No one asked me about that, so that's good. That probably means it's going to go higher. We closed into the gap today. All right, so what you had in Apple was a classic look below and fail. I think Buffett messed up the pattern here a little bit. I really was hoping, and I played Apple long. I wound up playing it long, but I was looking. I talked about Apple being, there's two ways to play it. One is looking to get in long somewhere around the primary trend in the 61.8. Apple, like gold, loves 61.8s, by the way. That was 85.72, and right below there was trend in the 84s. I also said, which wound up triggering the long, any move over 92.78, which was the breakdown day, that if any move over there would negate it and make it a false breakdown, and that was a long entry. We are now into the gap. We are getting close to some very key levels in Apple, and let's talk about those. 100.72 was an old top in the past in Apple. It's also roughly the 50% fib from the breakdown, which is 100.91. So somewhere in there you want to trim and trail. This 61.8 and the gap fill are about 103.60, and a big old breakout and old support point in Apple was 103.74. So at the 100 level-ish and the 103 level-ish is where you want to sell, and maybe think about taking some right or right out shorts, particularly at that 61.8 and gap fill. You have a mountain of supply above there starting really, I guess at 105 it starts. The real mountain starts around 108. If you could get up to 108, 109, there's a gap fill up there, 109, 110. That would be an amazing right or right out short area. But I think the 61.8 at the very least is a spot to take off and maybe look to start scaling in and trying right or right out shorts. So that's the Apple. I also like, and I talked today about closing some short out of the money puts just because they were murdered and the stock has been up a lot, and the risk reward when you only have a few cents left, you want to take that off. So that's Apple. Amazon, sticking with the A's. All right, so here's the scoop with Amazon. Seasonally, it isn't the best time. We are way overbought in terms of stochastics. The stock rallied from 474 all the way up to 722. However, we are above the last swing high range. Anything in Amazon, and I know this is a lot point-wise, anything above 696.44 to 684.82 is still rather bullish in Amazon. You could even get the gap fill, well, not that gap fill, but the secondary gap fill, and it would still be kind of okay. It just looks to me like it's consolidating a bit. The pattern is still bullish. I would love to play by the dip on a trend line touch if there is some type of a sell-off, like a Fed panic, for example. That to me would be good. Amazon, though, the pattern is still bullish. I think it's just going to consolidate and chop sideways for a little while. So if you want to do some, iron condors or some strangles, it's probably okay. Facebook, probably a similar type of looking pattern. As long as it's above 116s, you want to be long. In the past, it's chopped sideways for a few weeks, then filled the gap, and then ripped up again. The 200 MA in particular has been very strong support. That's down at 103. You have a gap fill around 108.8, 108.90. The stock still looks bullish to me. I think it's eventually going to get to 130. It's just a matter if it consolidates here and then runs up, or if it fills and then eventually goes. So I like Facebook. I'm a little iffy about it here, though, just short term. So short term cautious, longer term bullish. That's that. While we're in FANG, let's talk about the Netflix. I had talked about this one, probably seeing the 50 MA. That happened yesterday. Today it got even more. Got a little bit more. The gap fill is at 108. I don't know if we necessarily get that high, but we could get to the 103s maybe. The downtrend is around the 104s, but that would be if it happened tomorrow, or 104, 105. That area has been a major point of contention. As the stock rallies, I'd be looking to trim. It's still kind of in a downtrend. It's below the 200 MA. I would look for a move to the 200 and maybe a right or right out short against that. Let's keep it simple, stupid with Netflix. Twitter, that could have been a false breakdown yesterday. I don't really understand why firms are first downgrading a stock when it's on the lows. I mean, that just to me is silly. Anything above that lows, high of day, which we did take out today, above 1422, I think you could try right or right out long with a stop below the 1373. Really simple. Chipotle. All right, so I don't mess with this stock on earnings. I've had one very, very terrible experience with the stock that wound up costing me like 18 grand. I don't play around when I have things like that happen. I had done a strangle. This was a few years ago, and it had a huge gap down, and it was a gap and go. I wound up actually getting out of it. It could have been even worse, but I risk managed, and it wound up being only an $18,000 loss. Oddly, I've had even worse of those in the past when you get blindsided, but that was one, that was not a nice one. So I don't play that game with that stock on earnings. I do, however, play it regularly when it's not around earnings. So the deal with this is this. As long as the stock is above 452.78-ish. You have double hammers here around 453. So as long as you're above the 452, 453s, I think you can play long. Anything below there gets squishy, and you don't want to be long anymore. I'm just going to keep it. I'm just going to leave it at that. It really is that simple. Speaking of look below and fails, Gilead might be one of those. It did make a new low. We have rallied up quite a bit since then. We have some resistance that really starts coming in more heavily between 88s and 89. So if you were long, you might want to start looking to scale a little bit there. I have a fib on here, but it's the wrong direction fib. Let's do it the right way now. So are those numbers snapped right? I love when these don't snap right. So the 50% fib takes you to 92, which is almost entering the gap. The 61.8 doesn't even get the gap fill. It's up to 94. I think here that 50% fib is where you want to cut and run, the 92s. So, yeah, that's what I'm thinking. Somewhere between 89s and 92s. You could kind of play it by ear there. The 50 MA is 91.63. So that's what I'm thinking with regard to the Gilead. Financials. Financials are, everyone on TV talks about how cheap they are and they want to be long financials and how great are the financials and they've been down so long they have to go up. They're still in a downtrend. I'm looking at XLF. You actually got right to the down channel today, so it's kind of either they're going to break out or they're not. You had an inverse head and shoulder bottom in them. I had talked about that. I talked about the neckline snap. I played that long with Morgan Stanley. I'm not in that trade anymore, but I could be convinced maybe to get back into it. Morgan Stanley 26s are a very key line in the sand. I don't know anyone who talks about it, but I am, and it is. So we'll keep it like that. Really key level, we are making a higher high, and it is off of a higher low. So financials are trending up, which I guess has people thinking maybe the Fed is going to hike, right? Why else? So my problem with financials are these. I've talked about this before, and I think we're going to end on these. They need higher interest rates, and they need less regulation. These things are piñatas for regulators. Every time they want to raise money, they go and they hit them with something else. And one of these days, someone, probably Jamie Dimon, has to say enough is enough, and they're going to have to really fight them, because we all know with a bully, if you give them your lunch money every day, they're going to ask you. They're going to keep asking for it. You got to sock him in the nose and break his nose or whatever, and then that's the end of it. They don't bother you. They pick on someone else. That's the deal. So, yeah, if you want to be into these if you're playing for higher interest rates, I don't love the financials. They'll probably get a rally, but really their earnings capacities have been greatly diminished with all the financial regulation and their restrictions on lending and capital and the microscope that's permanently shoved up there where. I prefer the insurance companies. They make a hell of a lot of money anyway in their businesses, and as interest rates are going higher, they make even more because they put them into treasuries and other investments, and that yield boosts their bottom line. So those are like the Travelers, the MetLifes, those kind of stocks. I prefer them over the financials. But I do think premier franchises like Morgan Stanley are too cheap. I agree. I think they are too cheap. They could stay cheap for a long time, which they have, but when they get hit, if there's a disappointment and the Fed doesn't hike, and they get back below 10 times earnings, which is really cheap for a company like that, I don't necessarily know that they're as good as they used to be. Any of these companies are, because a lot of the profitability in financial markets is gone. The bid-ask spread. When I first started trading, they were using fractions. Now it's pennies. I mean, like Apple, for example, the bid-ask, it's 99.57 by 99.58. I mean, where's the difference in there? The brokers can't make any money on that. That's why it's all algorithmic trading, by the way. That's how they are making some of their money, with all this insanity with running stops and turning the market over to terminators. There's really not much money in the typical investment bank model anymore. the private prop desks are mostly shuttered, and these kind of shenanigans that oddly didn't even have anything to do with the financial crisis, although they were regulated out. By the way, after all years of all this financial regulation, the underlying cause is still there, and it could happen again. It was loose and reckless mortgage lending, and then writing derivatives on that and selling them abroad in contagion. Prop desks didn't cause the financial crisis. As greedy as these London whale type of traders are, they didn't cause the financial crisis. This was a systemic problem with loose mortgage lending regulations. If anything, politicians are probably trying to encourage that again, as nuts as it sounds. Eventually, we'll relive that crisis again. History does repeat itself. Or whatever, it rhymes. There'll be some other insanity. When you find lenders, when all big financial crises, and this is what's crazy. Every time you have a couple of ticks down in the S&P 500, everyone says it's 2008 and 2009 again. Until you start seeing credit spike problems in credit, you're not going to have the financial crisis. You need to have that problem. It needs to be a credit crisis, a money lending, borrowing issue. Counterparty risks, things like that. If you want to have a layman's barometer of that, just take a look at HYG. That's why I think Yellen got real nervous. It was looking like that could start happening. A lot of that pressure has alleviated itself. That's also starting to look like it could be an inverse head and shoulders or whatever. There is no credit crisis happening in the United States. I'll tell you that right now. If there is, I will let you know. It is not happening now. All right. I think we're done. Anyway, that's my story. I'm sticking to it. If anyone has questions, comments, would like clarification, just let me know. Leave me a comment. And, that's my story. I'm sticking to it. Let's have a good week, and I'll see you guys and gals on Sunday with the weekend review video. Cheers.